In this video, I want to look at an ironclad ETF combo of SCHD and SCHG. There are several goals here. First, I want to understand why would one even pursue this combo. And second, I want to compare it to the performance of some benchmark like S&P 500. And stay to the end of the video. I will look at what happens when you replace SCHG with VGT. The results surprise me. First, what's the goal of having SCHD in this portfolio? The reason is simple. Schwab US Dividend Equity ETF is a gold standard when it comes to dividend funds. It has an exceptionally low expense ratio of 0.06%. SCHG selects stocks that consistently pay dividends over at least 10 years. The fund also looks at other metrics to avoid holding value traps with high debt load. All in all, SCHG holds about 100 stocks. Its holdings are stable value stocks in consumer, defensive, energy, healthcare and other sectors. What's the result from that selection process? It is extraordinary. SCHG's dividends grew fourfold from 2011 to today. In other words, if you invested in SCHG back then with a yield of 3.9%, it would be over 12% today. Very few dividends ETFs can match such outstanding results. But besides generous dividends, SCHG showed strong price appreciation. If we look at total returns for SCHG versus S&P 500, SCHD actually outperformed S&P 500 until about lately. That's also an exceptional result for SCHG given its focus on value. Conversely, S&P 500 is a blend of growth and value. Among its top performers are Apple, Microsoft and Nvidia that drove its returns. So, in my eyes, the fact that SCHG matched the performance of S&P 500 long term makes it a worthy consideration for anyone's portfolio. But what about volatility? Dividend investors often cite the stability of dividend funds in the times of turbulence and as a hedge against drawdowns. If we look at SCHG versus S&P 500, surprisingly we see some variation. For instance, during COVID, SCHG declined only slightly less compared to the S&P 500. To be fair though, SCHG declined by 8% less than S&P 500 in 2022, when the tech meltdown happened. So it's hard to argue that SCHG is 100% drawdown proof. After all, it's an equity fund. Finally, with dividend ETFs like SCHG, you get to enjoy your cash flow without need to sell your holdings, and that's especially handy in bear markets. And that's another psychological positive in favor of SCHG. When everyone panics, dividend investors and SCHG can sit back and live off their dividends. In my previous video, I compared SCHG with another two fantastic dividend funds like VIG and VYM. So check it out. Okay, so that was the case for holding SCHD in your portfolio. Its growing dividend income, its stability and focus on value are its strength. But what about having SCHG in your portfolio? Schwab US Large Cap Growth ETF is a fantastic fund. It gives investors exposure to large growth stocks. SCHG sifts through a universe of large-cap stocks with high earnings growth potential. Since its inception in 2009, SCHG has managed to generate total returns that exceeded those of the S&P 500 more than 2 times. This roughly translates into about 2% difference in average annual returns. SCHG holds higher beta high volatility stocks that show much higher earnings growth. They are large tech stocks like Nvidia, Microsoft, Apple, Amazon, Meta and many more. The fund has also one of the lowest expense ratios in the industry at 0.04%. Of course, SCHG high returns come at a price. The fund has a higher risk of big drawdowns and generally more volatility in returns. Over the past 10 years, when the S&P 500 went down, SCHG went down even more most of the time. During the tech meltdown of 2022, SCHG went down over 8% more than the S&P 500. Also, SCHG has higher variability of returns. That's something to keep an eye on. So why would you combine these two very different funds? There are several reasons actually, and first one is that having SCHD in our portfolio, we would compensate for higher risks of returns for SCHG. With lower drawdowns and growing dividends, SCHD introduces stability into our combo. When we look at the fund overlap between these two, it's actually zero. In other words, each fund holds a unique set of stocks. And the benefit of this is, of course, better diversification. True, you won't get perfect diversification with these two funds, and that's because equities tend to move in tandem anyway. Still, differences in sector allocations create less correlation between SCHD and SCHG. For instance, correlation between SCHD and SCHG is 0.71. That's materially less than correlation of 0.94 between SCHG and S&P 500. The second benefit of SCHG is its dividend cash flows. As we discussed earlier, you may not have to sell your shares to fund your living expenses as you have dividends. And sequence of returns risk is a big deal, especially in retirement. It means that you may face a prolonged period of time of negative returns. For instance, take 2007 to 2009. That was one of the worst periods to go into retirement. From peak to recovery, it took S&P 500 over 5 years to recover to its previous price peak. If you retired back then, you were running a significant risk of selling shares at very low prices to fund your retirement. This would make it harder for your portfolio to recover. The worst outcome from this is that your savings may run out sooner than anticipated. How would dividend funds like SCHD help in this regard? With consistent growing dividends, you won't have to sell your shares and lock at rock bottom prices. And of course, to live off dividends from SCHG, you may have to have a large enough balance invested into this fund. Only with that you will enjoy meaningful dividends from SCHG to fund your living. That's probably the biggest drawback of standard dividend funds like SCHD. To live off their dividends, at first you need a large amount of capital. For instance, with living expenses of about $70,000 a year, you need almost $1.8 million in funds to live off SCHG's dividend yield of 4%. The good news is that SCHG's growing dividends would produce more with time for you. From before, we know that SCHG's dividends grew by about 10% on average each year. And that's more than the rate of inflation, as we saw before. So with time, you may potentially have more money on your hands than you may need, and that will allow you to spend more on discretionary expenses and other purchases in retirement. And of course, you will want to have SCHG in your portfolio for its exceptionally high rates of returns, and that will compensate for SCHD's more moderate and stable rates of returns over time. So how would a portfolio of SCHG and SCHD compare to some benchmark, let's say to S&P 500? Before, we saw that both funds either beat or matched the performance of S&P 500. So it's not exactly surprising that the results that this combo produces are outstanding. Let's start with 50-50 allocation between the two. First, the blended dividend yield is around 2.2% since SCHG's yield is so tiny. As expected, this combo has beaten the S&P 500 since 2016. The cumulative total return difference is 33%, which is pretty good. Despite SCHG introducing volatility into returns, SCHD allocation helped offset this variability. As a result, on a volatility-adjusted basis, our combo did better too. In this analysis, it is assumed that all dividends are reinvested. Over this 10-year period, you receive a $3.8 thousand in dividends. This dividend income contributes about 15% to total returns. A bigger question is, of course, what kind of allocation you should have between these two. And that depends on your age and preferences as well as risk profile. For instance, if you're a young investor with lots of working years ahead of you, then allocating lots of more funds to SCHG will make sense. But as you approach retirement, shifting funds towards SCHD is a solid option. And of course, you may want to consider having bonds in your portfolio. If you shift your allocation in favor of SCHD, you will introduce more stability in your portfolio, and you will also enjoy more dividend cash flows at the expense of lower total returns. Conversely, allocating more to SCHG, you will introduce more and higher returns in your portfolio. But of course, this comes at the expense of higher risk and variability of those returns. And that's the main trade-off in this combo. Now, is this combo of SCHD and SCHG the best for total returns out there? Of course not, but it's pretty solid given what's available out there. I have one quick caveat here. What we've seen so far is based on historical performance, and we can sift through many other funds and find those that even showed better returns. But it doesn't mean that in the future they will continue their outperformance. For instance, take Vanguard Information Technology ETF or VGT. Let's see what happens if we replace SCHG with VGT. VGT is a tech sector focused fund. I also reviewed it before on my channel. It comes with some pros and cons. VGT performed better than SCHG. For this reason, our 50-50 combo of SCHD and VGT has higher returns compared to SCHG plus SCHG portfolio. Over the last 10 years, the total return difference is about 50% on a cumulative basis. That's an extraordinary result. Here's another graph showing total returns for VGT and SCHG. Since 2009, VGT outperformed SCHG by almost 350% on a cumulative basis. That's huge. We don't know if this outperformance will continue into the future for VGT. But if it does, then it's worth replacing or at least including some of VGT in your portfolio. What do you think, guys, about this combo of SCHD and SCHG? Do you have it in your portfolio? And how does it perform for you? Let me know your thoughts down below. As always, thank you so much for watching. Subscribe to my channel for more videos on investing in the future. And I will see you next time.